to get started. Let me open today's session by just welcoming everyone to the University of Denver, in person or virtually. It's wonderful to have you here for our workshop. We had a very nice talk by Dr. Randy Ray last night to open the workshop, so I'll keep this introduction quite short. We're starting with two consecutive paper sessions. These are works that will hopefully be featured or will be featured in a special issue in the journal Post-Keynesian Economics. And we're very excited to welcome as our first speaker, Malcolm Sawyer, who will be joining us from abroad, followed by Dr. Korkut Ertürk from the University of Utah, and Nina Eichacker from University of Rhode Island. And with that said, I will now turn the floor over to the session.
Good morning or good afternoon, or for me, good early evening. And firstly, to thank and congratulate the organizers of this workshop for putting on this workshop in honor and memory of our friend Tracy Mott. I am sure I share with many of you of having very many fond memories of interactions and discussions with Tracy, I think over nearly 30 years in my case. And it was always good to be able to talk to him. We shared two particular passions. One was the work of Mikhail Koletsky, and the other was the music of Buddy Holly. Though I guess for many in this audience, it may be Buddy Holly was before their time. But it was always a great pleasure to meet with Tracy at conferences and in Denver, and I have these fond memories. So next slide, please. Yeah. So the paper is in these sections. I imagine that I will not get through all of them. It's not in the full detail I was that is in the paper. So I want to just begin by some reminders of the general slowdown of growth over the past 4 decades, which I think could reasonably be described now as, if not stagnation, at least a general slowdown of growth. And by this I refer mainly to the global north, the industrialized countries, and the figures I'll give refer to in the main either the G7 countries or the OECD countries. And at the moment, one of the aspects of the paper which I hope to be able to develop is the implications for the so-called emerging markets or developing countries or South, which I don't know at the moment, nor do I take into account the interactions between global North and global South. So as I think is kind of well known, one of Tracy's heroes, I think Joseph Steindl, wrote his famous book on maturity and stagnation back in 1952. And I want to look to some extent at the ideas about stagnation from there. But before I do that, I just want to very briefly mention what I call the main extreme perspectives on secular stagnation. That's mainly people like Larry Summers and the ideas about the declining natural rate of interest. And I want to indicate what I see as the main features of a monopoly capitalism perspective on stagnation. And in this, I very sketchily draw on the work of Steindl, also Koletsky, and perhaps a particular influence in my case is the work of Keith Cowling, who did draw heavily on Koletsky and Steindl's work. But then particularly I want to move on to look to see what could be thought of as the empirical considerations in support of the monopoly capital perspective. And as I, to some extent, will see it, is that monopoly capital perspective analyzes certain forces at work within monopoly capital, which are leading in the direction of a slowdown of growth and secular stagnation, which contrasts, I think, with the mainstream perspectives, which are largely almost exogenous factors. Something has changed savings behavior, or something has changed investment behavior, and that leads to some secular stagnation, which often comes down to more high levels of unemployment rather than slower growth. So then I want to look at these some of the empirical considerations, just to indicate that some of the changes in the structure of industry and so forth fit in with the monopoly capital perspective and the monopoly capital ideas on the factors leading to slowdown of growth. But I also finally want to briefly mention some other factors which may be impacting upon economic growth, which I think, at least in two of the cases, can be, or maybe even all three, related to a monopoly capitalism view. So the one is the effect of globalization and the interaction between globalization and growth. The second one, which I think had more links perhaps with the monopoly capitalism view, is the financialization, the growth of the financial sector, and the impact which that has sometimes on speeding up growth through consumer debt and so forth, but more generally maybe slowing down growth. And then finally, I just want to very briefly mention climate change. In part, I mentioned climate change. I think one of the issues I think I want to explore much more, is the interaction between what appears to be a slowdown of growth in general and the arguments that for degrowth or much slower growth in response to climate change and the climate emergency in general. Next slide, please. Okay. Now, all I've done in this graph and the next one as well for each of the G7 countries is to estimate the trend growth rate per capita, GDP per capita growth rate over a 10-year period. So the dates along the bottom, like 1960, the first one, the figure that is given is the trend growth rate for the decade beginning 1960, 61, 62, and so on. So I think you can see the general downward trend, and indeed really quite marked if you taking the 1960s for some of us, the glory days, but the 1960s with a growth rate of, on these figures, 4% of per capita income, now down to round about 1%. Okay, next slide, please. And these are the figures for the G7 countries. I think you can notice the sharp decline for Japan, not which comes as a surprise, and somewhere there is the essentially zero growth of the Italian economy, and I think also the British economy is now getting fairly close to that. I think it's been about 0.75% in the last few years. Okay, next slide, please. And so what I do the next, just here is just a quote from a number of authors that on their findings about the long-term growth rate. The first one by Leah Mendita Munoz is for I think it's the G7 countries in terms of the slowdown in growth rates, which in a sense confirms the sort of figures which were in those graphs. So these are rather more sophisticated ways of estimating it than the ones I've used. And then one for Kiefer, which is only for the United States, gradual decline in potential output growth in that case. Next slide, please. Next slide, please. And two more. One is from Steve Storm, again, looking at the general slowdown in growth, and he looks at it by certain sectors as well as more generally. And then one which is from Philippon, a very recent paper, which is where he argues that total factor productivity is more a linear function of time than exponential. And so starting off at in his estimates, total factor productivity for the United States estimated as rising by 2.45% per annum in 1947. And then if you calculate his figures through, it keeps declining. And if it projected on, these are my calculations, projected on, declined to 0.7% by 2050, and then 0.5% by 2010. So these are just indicative of the slowdown in growth over the last years. Okay, next slide, please. Okay, so I spent most of the discussion on secular stagnation is either mentioned Summers or Gordon. And Summers is essentially increased propensity to save, decreased propensity to invest, and in the loanable funds framework leads to lower natural rate of interest. I think, as I mentioned, these driving factors could be viewed in some sense as largely exogenous. They're not. There's no particular explanations of why these are occurring, which are relating to secular stagnation. And then Gordon is, of course, a slowdown in technology. There are some other factors, such as a slowdown in education, in his view. The next slide. So I see the monopoly capitalism, as I say, drawing on authors such as Steindl, Kletsky, and Cowling. I would put it together as, on the one side, it's an aggregate demand story. There's increasing monopolization, increasing oligopolization, which leads to a stagnation tendency in terms of a deficiency of aggregate demand. So rising concentration, industrial concentration, leads to higher gross profit margins, then on the whole, a tendency for the share of profits to rise, and with the usual argument, particularly in a so-called wage-led system, that would lead to a decline in economic activity. There is also a mechanism, which I think Steindl particularly plays, is the notion that a downward revision to planned investment leads to a reduction in the level of profits in the whole system, and also leads to lower capacity utilization, which may then reinforce the decline in investment, the lower levels of planned investment. Next slide, please. So these are quotes from Cowling. So it's in his view, oligopoly and maldistribution of funds by shifting profits to those industries which are reluctant to use them. So it's a view that, although, and I suppose this relates to the paradox of often observing that profits have been rising and the investment has not. And then That's the point I've already made. Oligopoly leads to a decline in the degree of utilization, to increase the markup or reduce the markup in the face of a decline in investment. But I think also an important line of argument, which Steinberg didn't go into, but Koletsky mentioned, and Cowling puts quite a lot of emphasis on this, is the notion that oligopoly will tend to stifle innovation, or the nature of innovation will be that which will serve the oligopolists, and often may involve essentially oligopolists keeping new ideas out of the market because that would not be in their interest for it to go ahead. Just as an aside here, and something I want to go into further, is the idea that we seem to have a slowdown in productivity or total factor productivity, innovation, and so forth. Yet at the same time, research and development expenditure relative to GDP appears to be rising in most countries. So that's something I need to explore. But the idea that oligopoly it's almost like an anti-Schumpeterian type of argument that oligopoly stifles innovation. Next slide, please. Slide, please. Thanks. Okay. Now, what I do in the next few sections in the paper, I'm just going to give you a very brief overview here. Is that I pick out bits and pieces of information and findings which relate to these monopoly capital stagnationist arguments. So the first one to notice, just give some quotations here, that the idea of rising industrial concentration across many countries, the two quotes largely relate to the United States, and this I think stands in a bit of contrast to the position of what I recall in the 1950s and 1960s, when concentration in the United States was not rising. Though I think my first academic paper was showing how fast industrial concentration was rising in the United Kingdom, and the UK stood out as a place where concentration was rising particularly. But these are indicating that this industrial concentration has continued to rise. Has started to, well, in the UK's case, continued to rise in the case of the United States over the last 3 to 4 decades. But that the sort of like the monopoly capitalism argument that the tendency for concentration to rise, these recent appeared validated. Next slide, please. And these are some more on industrial concentration, and then linking that with the profit share or the average markup following the rise in concentration. So again, fitting in with the now for the innovation and technical change, I'm taking this slide here now, just quote from a study by Thomas Lambert. He's done a number of other studies which are have a similar thrust. His line of argument is that it's declining concentration, increasing market concentration, and so forth, which is having a negative effect upon technical change or the implementation of technical change. Next slide, please. I think it's fairly well known that, or very well known perhaps, that there's been a general shift from wages to profits, and also a lot of evidence, though not universal, for there being wage-led rather than profit-led growth. So the shift towards from wages to profits would tend to slow down growth from an aggregate demand perspective. And this again, I think, fits in. I don't have any particular references here, but it's there's of course a very large literature on both the shift from wages to profits and for the discussion and debate over the evidence on wage-led versus profit-led growth. Next slide, please. One of the arguments that I think Cowling, for example, puts, but it's a more general argument, is of course that if there is a slowdown in, or there's a increase in savings but a decrease in investment propensities, then budget deficits could step into, as it were, to pick up the difference between potential savings and potential investment. Within the monopoly capitalism literature, and particularly, of course, the work of Koletsky, would cast doubt upon whether that will actually apply. I think Koletsky, Cowley makes the argument that these are by no means automatic. What I put up is these figures, which suggests that there has still been substantial budget deficits. They have not entirely secured full employment by any means. I haven't got the figures here, but I seem to recall the average for the OECD countries has been an employment rate of about 7% over these years. So next slide, please. So that despite, well, that's because of, as I say, periods of austerity and fiscal consolidation, budget deficits have remained substantial with a particular trend. And I think this is suggestive of a savings investment gap. They can also be the foreign trade position as well, but comes into this for particular countries. I think the budget deficits do kind of suggest to me that has been a continuing savings investment gap, even if it hasn't been fulfilled to the extent some of us might like to secure full employment, but there is this idea that savings and investment have been there's substantial in the main between them. And I think that also reflects back to the Summers type of argument in a way, that if, after all, if there is a low natural, very low or natural rate of interest, which I suppose I cast doubt on whether that really exists anyway, but the budget deficit could always meet the difference between policy. Okay, next slide, please. Okay. I just wanted to mention, and I'm clearly not going to have time to develop this, and this is some areas where I want to, I think, do further work. Because firstly, we usually think of the last 40 years as being periods of globalization, or some would call it hyperglobalization. And with particularly the growth of international trade and the links between growth of international trade and growth of GDP, there's always been this debate about which is the direction of causation. But this study by Heimberger suggests that there is some effect of globalization on output growth, but it's been coming down. Or is it's when you correct, after you correct for the bias, the publication bias and so forth, it's significantly reduced, and also that a zero effect of financial globalization on growth cannot be rejected. And also now there are recent trends since the global financial crisis. There's been a slowing down anyway of international trade and foreign direct investment. So this may be having a reducing somewhat growth, although clearly there is a two-way relationship between trade and growth. Next slide, please. I think the financialization, as a very general term, I think can be linked to some degree, at least saying that in the people like Tracy were linked with monopoly capitalism. But the particular one I want to point to here is that there used to be a literature which argued that was what was called financial development, so just general growth of the financial system, was positively associated with the rate of economic growth, because financial development is supposed to facilitate savings and channeling and monitoring of funds into investment. But I would argue that the bulk of the evidence, which I've surveyed in a number of places for recent decades, is the cessation of such a positive relationship. And indeed, some would argue that in many respects, the financialization may lead to a slowing down of growth, partly that it's
hi Malcolm.
Sorry.
I hate to interrupt, but I'm not sure if you saw my time warnings in the chat. If you can sort of bring it to a close I apologize.
Yeah, that's fine. I've got one more point. so next slide, please. And the last point I want to make is and again, I think this needs a lot more exploration, is the effects of climate change on the growth of productivity and the growth of output. And here I just quote again a number of studies which have argued that climate change is slowing down growth. And of course, if any growth continues in the future, this will have even more devastating effects probably on growth. This falls outside of the realm of monopoly capitalism, except that monopoly capitalism and its growth may be factors which are helping promoting climate change, and in that sense. But these are other additional factors which are running alongside, and I would say maybe having some effects on the slowdown of stagnation. Now, the argument I would love to be able to develop is to try and foresee the future, but just believe it, which I think this is the, I think surprised and shocked indeed how little focus there has been on this secular stagnation, its causes and the consequences for the future. Not much of the political discussion still seems to be on the basis that if only we could find some new trick, we will get growth going again. But this seems to run against some of these underlying forces which are slowing down growth, and may well be that the future is going to be a much slower growth, whether by accident or by design. Thank you very much.
Thank you. Thank you. I changed the title of the paper, by the way. It's not the title on the program. So, and also for the German-speaking colleagues, the U in my name has umlauts. So, okay, but I usually forget how to put them in the Word documents. Anyway, okay. It's about financialization's new normal. What I mean by that, hopefully, is going to be clear, and that's what I'm going to concentrate on. And there's a part of the paper that I'm still working on, which I probably wouldn't have time to get to anyway. So now there are three characteristics that I focus on. in terms of what I mean by financialization. The first one, the explosive growth of the financial sector, is what everyone commonly agrees when they define what financialization is, right? The explosive growth of financial sector, defined broadly as a share of the economy, is the definition that you run into most commonly. I pick on two other things. One is asset price inflation, and the other one is the lackluster responsiveness of investment to equity prices. Okay? Now, asset price inflation is been a very important salient aspect, and not many people have written on asset price inflation. I think Jan Toporowski has been a notable exception, but we have very few people who actually focused on it the way he did. Now, let me just set out what my argument is from the beginning, in case I run out and don't have time to come back to emphasize what the conclusion is. I'm implicitly starting out with the premise that there is a new normal under financialization, and I'll explain what the old normal was, okay? And the defining characteristics of this new normal is that market evaluations, if you like equity prices, that are excessive, overvalued stock market, if you like. And the second one is that stock holdings that are part of short-term portfolio adjustments the way they never were, right? So if you like, the drastic reduction in the average holding time of stocks. And the question that I want to focus on particularly is, why hasn't stocks, or stock prices I mean, been self-correcting? And what are the different views as to how self-correction mechanisms might exist? Okay, so that's the main question that I'll be talking about. Let's go to Keynes. In chapter 12 of Keynes, on his long-term expectations, as many of you here know and have read, you have two different views of the stock exchange. One based on enterprise, the other one based on speculation, right? So the stock market, the institutional innovation of the stock market has contributed to enterprise basically by making the separation between real investments that are irreversible for society as a whole and making them reversible for the individual, right? That's a big historical innovation. But then on the speculation side, equity prices can be driven by high-ordered expectations, right? Beat the gun and so forth, in which case you end up with the casino capitalism. Now, my contention is that Keynes based his normal, building his theoretical edifice, if you like, in the general theory, on enterprise. So you have this very colorful, rich, insightful descriptions of how conventional valuations can be precarious. I mean, in the 1937 QJE article, he's much more plain and lucid describing this. So we know from the second strand in his argument that these conventional valuations can be turbulent and collapse, but soon a new conventional valuation will emerge. But the idea is that as long as these conventional valuations last, market participants or investors act as though these are uniquely correct. Okay, so this old normal, if you like, had these three attributes that I'm interested in. One, in terms of the building, the theoretical apparatus of the general theory, it focuses on the short run. So you get this separation between debts, prices of debts, bond market, and equity, stock market. So the short run takes long-term expectations given, right? So the expected prospective profits are held constant. And then in the short run, the emphasis is on what is going on in terms of the price of debt, right? And so the assumption basically boils down to what I said earlier, that leaving aside these periods of casino capitalism or turmoil and so forth, these valuations are uniquely correct. Number one. Number two, implicitly, and this I didn't realize this for a long time, that stocks are really mainly held for income. They're not part of the liquidity preference portfolio adjustments. Just a couple of quotations that I'm assuming people are familiar with. Maybe we shouldn't spend time, right, when he's talking about how these conventions are unique and so forth, uniquely correct, right? The second one is very interesting, where he talks about short-run changes in long-term expectations. This is very interesting because you really have to be careful what that means. That basically refers to notion that stock transactions are not really a part of short-term portfolio adjustments resulting from shifts in liquidity preference. So what's the new normal? Putting it in a different way and from a more kind of a financial markets point of view, you would, from different types of literature, a salient thing you run into is overvaluation of stocks. Whether we're looking at heterodox economists, non-mainstream and mainstream literature, but also the more kind of applied, the Wall Street view things, right? That's something that's a salient theme. Behavioral finance theory, of course, also has focused on that thing. So few people would accept today or think today that market valuations under normal circumstances are uniquely correct. I think everyone kind of takes it for granted that the normal case has become overvaluation. Secondly, stock adjustments and portfolio adjustments are huge. Right? There have been an explosive increase, there's been a dizzying reduction in the average holding time. And again, you run into these two themes in very different types of literature. So that's the new normal. Okay. So what I want to do is focus on the main question that I mentioned at the beginning. Why don't these stock prices overvalued valuations not self-correct? I mean, this is not like what Keynes was talking about. Like you have conventional valuations collapsing, but soon enough, new valuations emerge. It's different. Now, I'm not going to talk much about chapter 17 because we don't have time. He basically gets into a discussion of how real rates adjust to the money rate at a more abstract level. But two themes that are relevant conceptually is, of course, the importance of rate of substitution and elasticity of production. Right? Why is money unique compared to other real assets is because there's low substitution, right? Real assets, if their rate is excessive, that means they're expensive and there'll be substitution to other assets. And that's going to check that excessive high return. Secondly, positive elasticity of production. If the return yield is high, then production is going to expand. That expanding production is going to bring down the yield, right? Which doesn't happen with money, at least nothing to the in any kind of comparable extent. Right? So again, we don't have substitution going on in the new normal, right? If you go to behavioral finance, there's all this literature about momentum buying, the noise traders. What do? They buy, right, when assets get expensive, and they sell when they are getting cheap. No rate of substitution is negative, if you like, right? Elasticity of production, again, one of the things I mentioned at the beginning, the investment has not been responsive, again, commonly agreed, and there are a few exceptions, to high valuations. Okay, so those intuitive level, those two things that Keynes was emphasizing is not happening. So I want to talk about Tobin's Q and another alternative mechanism of self-correction that Keynes talks about in his treatise on money, which might be relevant in terms of understanding this new normal. Before I get to that, just a quick footnote about what's been going on in the literature. Margolin, in his new book, Raising Keynes, argued that Keynes doesn't have a theory of interest, right? The liquidity preference is really a theory of the term structure of the interest rate. So in Keynes, if you like, rather than have deposits and bills, money is not interest bearing. So you just have money, liquidity preferences between bonds and money, and the rate on bonds determines stocks, right? So Margolin comes in and says, no, wait a second. The liquidity preference is an argument applicable to the term structure. And then the central bank determines the short-term rate, and then the liquidity preference determines the term structure and so forth. Now, this is a view Tracy Mott made significant contributions to, the idea that the liquidity preference determines the term structure and the liquidity premium in the term structure. Here's a very important paper that I'm going to come back to in a minute. And it's a view that goes back to Townsend and Kenneth Boulding, importantly. And again, amongst us, Randy Ray has an article on this from the 80s or early 90s, something like that. Now, here's something interesting Tracy Mott gets into, which I'm going to mention, and there's some degree of relevance in terms of sharpening my question. So what Tracy is doing a little bit differently than other people is to relate the story, liquidity preference, to Kalitsky's principle of increasing risk. And he says, okay, it's about term structure. You can think of the term structure in terms of the expected future short-term rates plus the liquidity premium. So you can go from short to long. But he says you can do it the other way. If the normal rate determined by real forces, a thing that Keynes was debating with Hawtrey and Robertson, then the term structure could then, the same argument about expectations can be used in reverse order. What is interesting in Tracy's argument, of course, is that he says, now, rather than the neoclassical real forces, which they had productivity and thrift, says, well, the only thing you really need to do is change those, get rid of those. So instead of productivity, you have profitability. And instead of thrift, you have distribution, right? So that affects savings, the distribution towards the wealthier and so forth. It's not thrift, right? But otherwise, there's that possibility that he raises in his paper. Now, the issue that I'm interested in is the divergence of perception of that profitability. Suppose profitability goes up, right? So the managers have realized that the profitability is going up, or it's stagnant, right? So that's one way of registering conditions of profitability. But then in financial markets, it's also registered in terms of market valuation, right? So the question that I'm raising is the divergence between the two. not as some kind of a turbulent, transient thing, but as a norm. Okay, let me talk about Tobin and then talk about the self-correction mechanism, which is consistent with chapter 17, but there are differences which can't get into here. But the principle might be similar, and then I'll talk about the self-correction mechanism I detect in the treatise. Now, the analogy that is useful is a timeshare purchase in a vacation. Right? Stocks can be defined either as titles to real capital, right? So just like you're buying a part of a home. So when you buy a stock, you're buying a part of the company's capital stock. Right? It's just like buying time slots in a vacation, right? There's another conception of stocks I'm going to get to, which is something very different. It's just a security. It's just like a variable income perpetuity console, okay? But let's leave that aside for now. So stocks are basically titles to property, like a time slot in a vacation, but the title is to real capital. Now, when the stock price increases, then what does that mean in the context of this conception? Well, then the net worth of the owner goes up. Just think about the housing example. The market price of your house is going up. Okay. Now, that increases the incentive to produce homes. And because of that higher incentive to produce homes, down the line, there will be a positive supply effect that will push down the price. There will be a dampening effect on the price, right? So you can see how self-correction will work in very intuitive terms. So if stocks are indeed like houses, what's the disconnect? The disconnect is on the basis of this notion of stocks, we can understand then how they can remain, stock prices can remain overvalued because there wasn't a positive response in production, right? There wasn't this supply response. So, okay, so that can explain why overvaluation could persist. But there's a problem. The problem is, why was there sluggish investment, right? So here are a number of problems with this notion of stocks. Now, if we think of stocks as titles to real capital, then we run into a difficulty, or the housing analogy starts to break down if there are no liquid developed secondary markets, the way you have for time slots in vacation homes. Right? So if you can't sell individual components, or these individual components, better yet, are not valued in markets, then there's a difference. Secondly, the amalgamation effects. This was something that goes to Veblen's magic dust, a discussion of stocks. So what this refers to, his magic dust refers to, is that what gives to the particular enterprise its value is not the sum of its tangible machines, right? But how it combines them. And many of those things are intangible assets. Oh, I don't find minutes. Okay. There are other technical issues, divisibility. If the capital is not divisible in the same dimensions as shares, then you can't, it's really like you can't sell your timeshare, a particular slot, unless everyone agrees to, right? Because only the house can be sold. So anyway, there are serious problems with the view of stocks as titles to real capital. So what's the second notion? The second notion is that it's basically security. It's a particular type of security, I'm going to go fast, has three attributes. It's a variable income console, it never expires. right? But it's not fixed income. Secondly, it's very conducive to making capital gains, so you can speculate one more easily. There are bond prices, of course, variable too, but nothing like what can happen in stock prices. And then when stock prices are really high, you can use them as collateral. Now, the relevant margin here is the expected profitability, the capitalized value of expected profitability on the balance sheet on the asset side, and the market value of claims against that future income. Okay, that's how Keynes looks at it in the treatise. Even though, when you look at, he uses interchangeably purchase of stocks as buying investment goods and so forth. Now, what happens when market valuation diverges from earning capacity? And this is the second self-correction mechanism I'm referring to. First of all, we don't have positive effect on net worth. Okay? And in fact, the cost of liability cost of businesses go up. When the stocks are overvalued, it becomes costly to finance investment by issuing stocks. Jan Toporowski, I can swear, it had some old papers that I couldn't find that was talking about something along these lines. Am I right? Okay, but I couldn't find it when I was working on this paper. Let me jump to what Keynes is talking about. And I have 2, maybe 3 minutes. There's a very interesting chapter in volume 1 of Treatise 1, where he talks about different types of speculative markets. So here, referring to what happens to this margin between the market value of claims against future income versus the expected real capitalized value of these profits, he says what matters is market opinion and sentiment. That's point number 1. Point number 2 is bank credit. Okay, so in terms of the first opinion, the ultimate judge of whether the market is overvalued or not is market opinion. Okay, and the market shows its hand by the size of the bear position. See, that's the part of liquidity preference argument in the treatise that got lost in the general theory when it turned into a theory of the interest rate. So all that literature that Tracy was contributing to, Martin is writing back, is taking us back to chapter 15 in some respects. The second thing is, so the basic idea is that you can have an overvalued market. Everyone knows it's overvalued. You have a separate one, not everyone, you have bears and bulls. There's this division of opinion, okay? And the bulls are financed by the banking sector. There's this colorful description of the channeling of bear funds to the bulls. It doesn't have to be exactly the bear funds, okay? But you get the idea. So you basically have, in this discussion, expansion divided into 2 phases. The first phase is a bull market with a consensus of opinion, where on the left-hand side, on the asset side, we have the expected future capitalized value of profits. Okay, pi is the capitalized future profits. On the right-hand side is the price, right? Claims against it. So in the if the 2 are always moving together, then the net worth changes are not are nil. Okay, I'll finish with this. So in the first phase, the stock prices are not rising as rapidly as expected profits. So this is the period when speculation is actually stabilizing and so forth. And the second one is the interesting one that I'm trying to use on the technical part of the paper that I'm still working on, that can be fruitfully applied to the new normal. What's going on in this second phase? He calls the bull market a division of opinion, where expected profits, the increase in the expected capitalized value of expected profits, have lagged behind stock prices, right? Because of the bull influence, if you have some kind of a bubble dynamics, and it can go on under certain circumstances, and that gives thinking clues as to how we can then understand what's been going on in the new normal. Okay, so let me stop here. I ran out of time already, and thank you for your forbearance with me.
Thank you for coming, everyone. And again, thank you for organizing this session. It's a real pleasure to be here. My name is Nina Eichacker, and I'm still an assistant professor at the University of Rhode Island. And my presentation today also has a different title than what I submitted. Sure.
I'm so sorry.
Sure.
And yes, don't deduct this from her, from Nina's time. A crucial step, sharing the presentation.
Yes.
Okay, continue.
And so this presentation is government in the money view, sovereign debt, liquidity preference, and the fiscal monetary nexus. So this project has grown out of work I've been doing, looking at monetary policy and how it has facilitated or constrained fiscal expenditure. And my research into this really kicked off with looking into what happened during the Eurozone crisis and the doom loop, specifically for peripheral economies' sovereign debt. My desire is to bring government spending and sovereign debt into post-Keynesian models of endogenous money, where we assume that liquidity preference can change over time. In the context of this is stemming from apparent changes in liquidity preference and investment behavior by firms in the context of the COVID pandemic, where we had a drawback of private sector spending and lending early in the pandemic. And what we are seeing in the as the global economy returns to normalcy, and we're seeing that certain industries are apparently constraining their production of output. We see this particularly in fossil fuel production. So those motivations were possibly for different reasons. It's also about the value of the government specifically as a spending and liquidity providing agent. And also thinking about the variable ability that governments can play in these outcomes along core and periphery lines. So as Randy Wright was talking about yesterday, we might assume that core economies face little to no challenge in spending, that the central banks of those countries have little keeping them from facilitating spending in moments of crisis, whereas peripheral economies don't enjoy this same latitude in global capital markets. So it's thinking about liquidity preference and demand for sovereign debt issued by core economies versus peripheral economies during periods of stability and crisis. And I think that there's a lot of important implications that this all has. We can think about the divided experiences for core economies that issue liquid sovereign debt compared to peripheral economies that issue sovereign debt that may be seen as a profitable or an investment asset. If we think about periods when demand for sovereign debt issued by developing and emerging economies increases, that tends to be during periods of low yields on core debt. I'm thinking here specifically about like the 2010 to 2015, 2016 period. But then in moments of crisis, there tends to be a reversion in sovereign debt markets away from peripheral issued sovereign debt towards core debt. We see rising demand for the dollar, we see rising demand for US treasuries, we see rising demand for German bonds, et cetera. What does this mean for governments that are trying to intervene during financial crises, where they may in fact be assisting central banks in directly bailing out financial institutions? Which central banks are able and or willing to minimize volatility in sovereign debt markets, or any other debt markets for that matter, in times of crisis? And what types of fiscal expenditure may be facilitated or constrained by these policies. So if we think about periods of novel monetary policy in the Eurozone, for example, how much of the ECB's apparent about face in 2014 was related to bailouts for banks relative to facilitating government spending on social welfare? I think that's an open topic for debate. This paper puts forward the idea that government spending, like private sector spending, can increase money in the economic system through the flow of funds that follows, and by directly providing liquidity to banks and other institutions during periods of crisis. When liquidity preference changes, such as during times of crisis, peripheral and smaller economies have a harder time issuing debt and fostering economic and monetary activity than core economies do. And I argue that some of this is related to banks and central banks' behavior when it comes to the facilitation of that spending. And when monetary authorities are more accommodative of fiscal expenditure through the extension of novel policies, they enable this expenditure by governments or alternately other sectors of the economy, if we think of other liquidity facilities that have arisen recently. So this paper introduces sovereign debt into the framework that Mott used to consider corporate borrowing and demand for corporate debt and similar assets in a Keynesian model of liquidity preference. So I'm doing something slightly different, but Mott's paper was talking predominantly about corporate spending. What motivates firms to spend? What motivates banks to purchase those assets? And his argument was, as I interpreted it, was that we could imagine excessive bearishness or rising liquidity preference potentially stemming banks' willingness to acquire those assets with implications for liquidity provision to firms. But we might also imagine firms themselves holding back in moments where they perceive lower profitability. So this starts from the premise that government spending is typically responding to different challenges than firms' spending does. A government is not looking for a profitable return on its spending, but it may be filling in gaps in depressed private demand. And so it also considers the relevance of sovereign debt in the general approach to endogenous money in post-Keynesian theory, which is the sort of melding of the accommodative approach to endogenous money and the structuralist approach to endogenous money, which notes that if liquidity preference changes over time, we may see changes in central banks' relative accommodation or accommodativeness of bank lending through the provision of liquidity in various ways. And finally, it illustrates the utility of government spending at the economy-wide level and in the monetary system with Merrilling's money view framework. So if I have time, I'll go through all of that. I may not. Sovereign debt and liquidity preference. As I mentioned, Mott's 1985 paper is predominantly talking about the private sector. It's talking about why firms issue debt, why firms borrow, why firms engage in investment, but it's also thinking about the financial institutions side of that story. And it considers how liquidity preference may influence firms' relative willingness to spend, relative willingness to borrow, but also financial institutions' relative willingness to provide capital to firms through lending or other means, based on their relative liquidity preference or their relative bearishness in their view of the market as a whole. So what this paper picks up on is the notion that demand for sovereign debt, like demand for corporate debt, may be subject to liquidity preference itself. We can think about demand for sovereign debt. There's a low battery notice saying it may turn off if it's not plugged in. Sorry. So I'll keep talking and hope the screen stays live. Demand for sovereign debt may increase relative to corporate debt if it is viewed as more liquid or if corporate debt issuance is in short supply. Sovereign debt may also be a source of profit or a safe haven for liquidity. And here we're thinking about the difference between what motivates investors to purchase sovereign debt issued by developing or emerging market economies versus core economies. And how do changes in liquidity preference, and it talks about how changes in liquidity preference that affect structural demand for different economies' sovereign debt may affect those governments' ease of spending, especially in times of crisis. This may not be a concern for core economies or gigantic economies like the US, but this may be a big concern for smaller economies that are more vulnerable to global perceptions of creditworthiness. So if we think about credit markets and sovereign debt, we can think about the increased importance of sovereign debt as collateral for liquidity operations over time. There's a growing literature about shadow banking and repo finance in Europe that focuses on the importance of short-term repo exchanges that increasingly prior to 2008 used sovereign debt issued by European Eurozone members, and how prior to 2008, all of that debt was valued the same way, and how after 2008, changing perceptions of the creditworthiness of peripheral members of the Eurozone and core members such as Germany created volatility in credit markets that led to downgrades of peripheral economies' sovereign debt, which exacerbated private creditors' willingness to sell off that debt and flee to more liquid sovereign debt issued by Germany and other core powers. But we can think about sovereign debt as collateral for monetary operations in like the textbook case in US monetary policy is the Fed buys a treasury bond. We can think about how in the Eurozone, monetary policy has become typically operated in a repo model where collateral often included sovereign debt issued from across the Eurozone. And we can also think about recent credit facilities like the Fed's FEMA credit facility during the COVID-19 crisis that allowed economies to exchange US treasuries for dollars through the Fed's facilities. When we think about the money, like endogenous money at the economy-wide level, this paper assumes that liquidity preference matters, and it assumes that liquidity preference can change over time. I use the general approach to endogenous money in this paper, which is, as I mentioned, like a melding of the accommodative approach to endogenous money that assumes that central banks will provide demanded reserves to banks that are deemed creditworthy in need at given interest rates. We can assume that this is mostly unlimited at any given point in time, but that over time, liquidity preference may change. So where central banks may have been willing to provide reserves at a particular interest rate at a lower level, that may increase over time as the central bank's perception of the economy changes. But we could also envision this in terms of, in a moment of expansion, perhaps where banks are lending to different borrowers. We can imagine a scenario where banks are lending to a broader swath of the population and other liquidity concerns that may come in over time. So over time, liquidity preference and willingness to provide reserves or engage in other expansionary or contractionary policies may change. So this paper is thinking about whether and when central banks provide liquidity support when banks need it. And it is thinking also about what assets central banks may accept as collateral for monetary operations, and whether central banks are ever willing to act as dealers of last resort, where they are not merely accepting assets as collateral for operations, but when central banks are willing to outright purchase assets that are deemed unbearably volatile and potentially limiting activity at the economy-wide level. So we assume that banks are going to hold some balance of more and less liquid assets that may be depending on requirements. It may be related to economic circumstance or relative bearishness or bullishness about the state of the economy and the state of borrowers and so on. And changes in liquidity preference may themselves stem from changes in economic circumstances. If the economy goes into crisis, we might see firms pull back from borrowing, but we also may see banks pull back from lending out of fears of potential creditworthiness of borrowers. Alternately, we might see periods where banks become increasingly willing to lend. So these dynamics don't always have to move in a more restrictive fashion. We can imagine circumstances where they move in a more expansive fashion too. But they may also stem from pushback from central banks. So if we think about the Eurozone crisis, for example, in the moment of escalating crises in the Eurozone crisis, governments of Ireland, Greece, Portugal, I believe, requested the ability to provide emergency liquidity assistance, or rather their central banks did. And in those cases, the central bank or the European Central Bank actually said, no, not unless you agree to certain extremely punitive conditions will we allow these measures to take place. So one can envision, and this may not apply to everyone, but one can imagine circumstances in which a central bank or a supranational central bank like the European Central Bank actually intervenes to prevent liquidity operations from taking place. Thank you. And then finally, we might think about access to or exclusion from existing or novel liquidity programs. So when we think about recent, very recent years, or even going back to 2008 and 2009, and the novel liquidity facilities that the Federal Reserve created after the 2008 financial crisis, and following the onset of the coronavirus pandemic crisis in markets, certain central banks had the ability to access very generous liquidity programs. If European banks had branches and subsidiaries in the US, they could access liquidity support related to subprime mortgage-backed assets. But if banks did not have operations in the US specifically related to those assets that came to be considered toxic, but were hurt by changes in global credit markets that followed the onset of the global financial crisis, those banks did not have access to those services. We might think also about who received, which central banks receive access to dollar swap lines from the Federal Reserve, and the fact that those central banks tend to be in big core economies like Japan, Canada, the UK, the ECB, Australia, and so on. And while the Federal Reserve increased the number of central banks that could access those services in the aftermath of the 2020, there was still a very strong delineation between which banks qualified for that, which banks and central banks qualified for that liquidity asset service, and which ones did not. So when we then think about how banks may respond to this going forward, we can then interpret subsequent moves by banks to purchase or sell assets based on their concerns about future access to liquidity in times of crisis. Finally, the paper is also going to talks about monetary hierarchies and sovereign debt. So since sovereign debt may be an asset that banks hold either as a profitable asset or as a liquid asset, we might think about which sovereign debt counts as profitable and which counts as liquid, because the changes in demand that follow from changes in economic circumstances may lead to heightened demand for more liquid sovereign debt and less demand for more peripheral sovereign debt, with subsequent funding implications for those economies as a whole. I have less than a minute left, so I'm just going to note that the paper The paper has several models going through it, but I want to get to what I think of as some of the key takeaways here, which is that government spending, like other sectors' spending, can increase economic activity and money in circulation, especially if it is funded from proceeds from selling bonds. Whether governments need to worry about that funding may be a topic for debate. Though governments may not require funding fiscal expenditure before every transaction, all governments are probably going to have to honor some, if not all, payment obligations at some points. So the ease with which core and peripheral governments can meet those obligations can matter in terms of how much spending they engage in going forward. Core economies are less vulnerable to rising rates in times of crisis because of the high position they occupy in monetary hierarchies. Because their sovereign debt is in high demand in moments of crisis, moments when those governments are likely to increase their fiscal expenditure are going to be matched by dropping rates, regardless of what central banks are doing to rates at the same time. Peripheral economies are more vulnerable to pressure from holders of their debt. We can think about how demand for sovereign debt issued by peripheral economies tends to fall during recessions, and there tends to be there's a high measured elasticity of demand for sovereign debt issued by more peripheral economies, where there tends to be a fast decline for it in moments of recession. And at the same time, those economies' obligations may be denominated in appreciating currencies, which creates a double dilemma for those economies, increasing their risk of default even further. Rapid changes in liquidity preference can hurt banks' abilities to access liquidity support. And we can think about this in the private sector, but we can also think about this in the public sector. For example, municipal governments early in the pandemic that were accruing debt and seeing falling revenues, worried about default prior to liquidity support from the Federal Reserve in the form of a liquidity facility for municipal debt. The relative willingness of central banks to engage in novel monetary policies can prevent these negative outcomes. And it's important to prevent these outcomes if we care about what governments are spending on. So going forward, I think it's really important to consider how best to extend these services to peripheral economies that are most vulnerable to these dynamics in times of crisis, and especially during periods where central banks in core economies are raising rates, creating new sources of funding crisis for those economies as a whole. Thank you. I'm sorry for the rushing at the end.